Welcome to the 2019 first quarter investment call with the San Diego Foundation. I'm Brian Zambano, Vice President and Chief Development and Stewardship Officer at the Foundation. Thanks for joining us today. Also joining us today is the San Diego Foundation's new President and CEO, Mark Stewart. Mark is a fundraising and community building professional with nearly 30 years of experience in all aspects of operations and leadership. Prior to joining the Foundation, Mark managed a staff of 64 and a budget of $14 million at San Diego Zoo Global, including development, membership, and government and community relations. Under Mark's leadership, San Diego Zoo Global raised $530 million in its first ever comprehensive fundraising campaign. Mark also served as the founding president of the Foundation for San Diego Zoo Global. He worked with the board of directors to fuel the vision for highly impactful programs like San Diego Zoo Kids TV channel, Wild Heroes for Military Veterans, and teacher workshops in conservation science. He's also the founder of an industry-wide collaborative to increase capacity, data sharing, and best practices for accredited zoos and aquariums. Mark has also been recognized as an outstanding fundraising professional by the Association of Fundraising Professionals San Diego and achieved accreditation as a certified fundraising executive. We here at the Foundation are thrilled Mark is here and welcome Mark to the Foundation. Also joining us today, I know are some new donors here to the San Diego Foundation, so welcome to the family and thanks so much for joining us. And thanks so much for our more longer-term donors joining us on the call today. These quarterly investment calls are an enhanced service to you as our donors. These calls provide direct access to our investment leaders in a consistent, convenient, concise format so donors can remain informed about the performance of their charitable assets. Leading today's discussion will be Steve Klosterman and Matt Fettig. Steve Klosterman is Regional Director at Halbert Hargrove and serves as Investment Chair of the San Diego Foundation Board of Governors. Steve advises a wide range of individuals and institutional clients and began his investment management career more than 35 years ago, building his own registered investment advisory business. Steve is past chair of the UCLA Foundation and founding board member at the UCLA Investment Committee, which oversees a $2 billion investment. As Chief Investment Officer of the San Diego Foundation, Matt Fettig oversees and manages our investment strategies and activities. This includes working with the Board Investment Committee, senior staff, auditors, professional volunteers, fund managers, and outside consultants to establish, maintain, administer, and monitor policies related to foundation investments. Before Steve and Matt get started, we'll get to hear from our new President and CEO, Mark Stewart. Mark?
Greetings. It's wonderful to be with all of you. While this is my first investment update as a San Diego Foundation staff member, I've enjoyed listening to and learning from the wisdom of Steve Klosterman and Matt Fettig on previous webinars. I look forward to meeting many of you soon, and I'm deeply grateful for your interest and support of our shared work and mission. Thanks.
Thank you, Mark. So today, Steve and Matt will start the call with a brief macroeconomic update, followed by performance and attribution reports for our endowment portfolio, our long-term, medium-term, and short-term portfolios as well. We will conclude with question and answer session. To submit questions, please use the questions chat function located on the webinar sidebar menu anytime throughout this call. Any questions unanswered during today's call will be answered via email. Attendees can access slides and a recording of today's call on our website at sdfoundation.org by tomorrow. Now, Steve Klosterman will get us started. Steve?
Thank you, Brian. Thank you, our donors, investors. On the first graph, it requires some explanation, but I think is illuminating. It shows starting in 2004, the best performing asset class, asset area of investment, if you will. So real estate investment trust that year had a 31.6% return. The worst return that year was cash with 1.2%. The colored boxes, there's 9 colored boxes, and then the gray that says asset allocation is a diversified portfolio. It's not our diversified portfolio, but it's a diversified portfolio. So in other words, it's having some money in every one of those boxes. In our diversification, we also have investments in some things not shown here. So we're even further diversified. But the significance, one significance of this graph is you can see there is no pattern there. The colors vary, they go up and down. You don't know what's going to be first, what's going to be last. And in fact, if you're somewhat biblically inclined, you will see in a few cases the first shall be last and the last shall be first. And I point out specifically emerging market equities, which is the purplish color, and it had 4 first-place finishes and 3 last-place finishes and 2 second-to-the-last finishes over this 15-year time horizon. So again, suffice it to say, nobody's smart enough to figure out what's going to be the next best investment area, and we do not try and do that. We try and run a very sophisticated, diversified portfolio. You'll also notice when you get to the end of that 15-year period, it shows the annualized return. So that's the average return per year. So in the case of REITs, it had an 8.5% annualized return. Where you see VOL, volatility, that's standard deviation. It's a measure of risk. The higher that number, the more risk. And lo and behold, that old adage you heard, risk return are alive and well and go hand in hand. REITs had the highest return. They also had the highest risk. Emerging market equities had the second highest return and the second highest risk. Small cap stocks had the 4th highest return, the 3rd highest risk, etc. If you look at the gray, the asset allocation, you see a pretty darn good trade-off, in my opinion. You've got a 6.2% annualized return and the 3rd lowest level of risk at a 10.3 standard deviation. With that, we'll go to the next graph. This is an interesting graph because it shows the average return before a market peak. Obviously, you don't know when the market's peaked until after it's peaked. So people who think they might be getting a hint about a market peak, if you look at these returns before that peak, suggest there is no hint. You've got 24 months prior, a 41% return. This is on the S&P 500 index. 12 months prior, 23%. 6 months prior, 15%. And just 3 months prior to the peak, on average return of 8%. There were a lot of people who bailed in the 4th quarter of last year with the assumption that we were headed for a bad market, only to miss one of the best quarters we've had in history in the 1st quarter of this year. Now, granted, what happens after the peak? It gets ugly, and it gets ugly fast. 7% down after 3 months, 11% down after 6 months, 14% after 12 months. But look at the average just 24 months later. It's -1. It's almost nothing. So that'll lead to another graph, which shows the intra-year decline. So the declines within a calendar year that occurred. So if you look at the very first bar, it's for 1980, and the year finished up 26%. But within the year, at some point, peak to trough, there was a 17% drop. So a very significant drop within the year, but still a really great return at 26%. Anyway, this graph shows those intra-year declines. Those are those reddish dots with all the minus signs next to them. So one point is intra-year declines are customary. And on average, they're very significant. You'll see on average at the top there, 13.9% is the average drop, intra-year decline, and this is for a 39-year period. But you also will notice that you're positive 29 of the 39 years. So you're about 70% of the years you end up with a positive return. We'll go to the next graph, which says all about time frame. And that's really one of the key points I wanted to emphasize with those earlier graphs. It's about your time frame. So if you look at just the S&P, the returns were positive 60% of the month. You go out to 1 year, 75% of the time. So if you just did a Rip Van Winkle and say, I'm only going to look at my portfolio once a year, 75% of the time, you're going to be happy. You get out to 5-year holding periods, and this is adding a year and dropping a year. It's rolling periods. So 1930 to 34 is a 5-year period, then 31 to 35, et cetera, et cetera. So you have lots of data points. And on those rolling 5-year periods, you're now have positive returns 90% of the time. You look at rolling 10-year periods, you're now 97% of the time with positive returns, and you get out to 15-year holding periods, and it's 100% of the time. And this is just the S&P 500. It's not a diversified portfolio. It's not a portfolio like ours here at the foundation. I would submit to you that our percentage of success, our percentage of positive returns would be even higher. And again, in our case, we're investors in perpetuity. So 15-year time frame may seem like a long time, but for us, it's a fraction of where we hope to be around. We'll soon be 50 years around. We hope to be around a lot longer than an additional 50 years. So I really want to emphasize these macroeconomic investment concepts about being a long-term investor and about diversification. And with that, I'm going to turn it over to Matt to get into the specifics of your portfolio.
Well, with that, thank you, Steve, and good morning to everyone. Thanks for joining us. I will focus on some shorter-term results today, but I will call to your attention longer-term results as well that I think put Steve's comments into a very interesting perspective. As you know, we had a very difficult end of 2018. Markets were quite volatile, and our portfolios produced negative results. But just after Christmas, there was a very dramatic turn in the markets as the Federal Reserve really softened its stance on further interest rate hikes. And markets have really rallied pretty significantly throughout the entire first quarter. So the key message I want to leave you all with today is, despite some of the recent volatility caused by politics, interest rate policy, and trade, the foundation's investment portfolios are off to a very strong start for this year. So starting with the endowment, you can see for the first quarter, the endowment was up 7.8%, outperforming its benchmark by a pretty considerable margin. We had gains from really every segment of our portfolio, as you see represented here in the pie chart. Domestic equities, which are essentially U.S. stocks, were the strongest performer for the quarter, followed by non-U.S. stocks and emerging market stocks. Over the one-year period, the endowment has lagged its benchmark, but look at the 10-year number, and it's really representative of what Steve said. An endowment portfolio is really meant to exist for perpetuity, and we tend to be very long-term investors given that time horizon of the endowment portfolio. And over the last 10 years, you can see the endowment has offered a 10% annualized return, well ahead of its benchmark, the policy index, and we're very proud of that number. So moving forward to the long-term portfolio, as you know, the long-term portfolio is invested very similarly to the endowment. The key difference is that the long-term portfolio does not have any of the illiquid securities that we can hold in the endowment portfolio because of that perpetual time horizon. The long-term portfolio was up 8.8% for the quarter, slightly trailing its policy index. Much of the drivers of performance were the same. Every segment of the portfolio was positive. U.S. stocks yielded the best results for the quarter, followed by non-U.S. stocks and emerging market stocks. So very similar themes here. The long-term portfolio, which we also manage with a very long time horizon, is now up 9.9% annualized over the last 10 years and well ahead again of its benchmark and policy index. The medium-term portfolio is managed in quite a more conservative fashion. It only has about a 30% allocation to stocks and about a 70% allocation to bonds or fixed income. Despite that, that 30% segment of stocks really drove performance for the first quarter, resulting in a 5.6% increase for the quarter. That is a very strong result for this portfolio, the way it is structured, and that is something we might expect more over a one-year time period rather than a one-quarter time period. But nonetheless, a very good number with only 30% allocation to stocks. This portfolio, of course, was invested heavier in bonds, but the bond market also yielded some pretty strong results for the first quarter as the 10-year interest or treasury rate fell. And remember that bonds have an inverse relationship between price and yield. So as yields fall, bond prices go up. And last is the short-term portfolio. And recall, this invests solely in money market funds. And money market rates are really a function of the shorter-term interest rates set by the Federal Reserve. For the majority of the last 10 years, we've had very low interest rates in this country, and it's resulted in very little return for this portfolio. However, over the last, call it 2 to 3 years, as the Federal Reserve has been increasing interest rates gradually, this portfolio is now yielding over 2% a year, as demonstrated by the results that we've seen over the last 1 year. So we are starting to see more yield out of this portfolio. That yield will fluctuate largely depending on future Federal Reserve policy. So with that, I'm going to turn it back over to Brian.
Thank you, Matt. Thank you, Steve. Now we'd like to take your questions. As a reminder, to submit your questions for the Q&A, please use the questions chat function in the menu bar. Matt, what's our first question?
The first question, which I will toss over to Steve, how do trade tensions affect the market and your investment portfolios?
Yeah, there's been a lot of obvious publicity and concern about tariffs. And I addressed this in a previous call and basically said tariffs are a tax. So then the issue gets to be who's going to pay that tax? Is it going to be the consumer of the good or service? So will it be passed on to that consumer? Or will the provider, the company, absorb that expense? Or some sharing between the two? So what our money managers do is they try and examine what the impact are going to be of particular tariffs, who can pass on that cost, and if they do pass on that cost, is that increased cost going to result in less demand for their product or service or not, and make good investments accordingly. But yeah, my big concern is with tariffs, and I'm very concerned that China might start looking at services that we provide and imposing some sort of tariff or tax on that, because President Trump always talks about tariffs in the context of goods. We are actually a net exporter of services. If you look at our largest accounting firms, consulting firms, law firms, they all have businesses overseas. They're all global, and they all have businesses in China. And so I worry about, in retribution, if they start talking about taxing services as well. Anyway, it's a big challenge for our money managers. As an aside, too, my other big worry is what I call a fumbling by the Fed. I don't want the Fed to raise rates too fast, too soon. It takes about a year to 18 months to work its way through an interest rate increase. So if you keep raising rates every quarter, it can have an impact where down the road you go, oh, we went too fast, too far. Related to that, I worry about pressure on the Fed from, President Trump about lowering rates. Or the Fed has traditionally been independent and should be independent and not feel political pressures and do what they feel is best for the economy.
Thanks, Steve. Another question that's come in: why is so much of your portfolio invested outside the U.S.? I'm happy to take that one. and we've talked about this if you've joined us on previous calls. We have about as much invested of our stock portfolio in the U.S. versus the non-U.S. The U.S. has certainly outperformed the non-U.S. over the past couple years, and we continue to have conviction in our holdings outside the U.S. So the question is why? And first of all, you've all heard the adage that past performance is not indicative of future results. We are a big believer in that, and if you look back at the very first graph that Steve showed, you see that different asset classes produce varying results year in, year out. Whatever did well last year is not always an indicator of what will do well this year. And as we look at non-U.S. stocks over the next 10-year period going forward and attempt to predict results, you're starting at a much lower valuation point for non-U.S. stocks than you are U.S. stocks. And starting at a lower valuation point is a good indication to us that you're likely to have higher returns coming out of that segment of the portfolio in the future. So that is the primary reason we maintain that exposure, and we hope to benefit from it over the coming years.
Thank you, Matt. Thank you, Steve, and thank you, everyone, for your questions. If we didn't get to your question during the Q&A, we'll follow up with an email. Thank you again for everyone for joining us today and for partnering with the San Diego Foundation to maximize the impact of your charitable giving. Today's presentation will be available by end of day tomorrow on our website at sdfoundation.org/investments. Thanks again and have a wonderful day.